Welcome back to Gecko Finance channel. I'm Artie and let's go. Today I'm gonna tell you how to start investing and how not to lose your money. So let's get right into it. Let's start with some basic terms. What is investing? Investing is the accumulation of investment instruments to generate passive income and to increase your capital. And passive income is when you do nothing and money just comes into your account, which is pretty cool. And investment instruments are very different. For example, real estate, intellectual property, in our case, financial instruments. And that's what we are going to talk about, because financial instruments have the lowest entry threshold. You can start with only €100 or even less. What are the types of financial instruments? The first, most obvious, is bank deposit. Bank deposit is a very low risk instrument, but the yield is very low as well. So in our case, it's more of a way to save money than to make it. The second instrument is bonds. What is a bond? A bond is a debt instrument, and a debt instrument means that someone needs money. And if you are willing to provide that money, you will get dividends from it. Those are called coupons. This is the first way of making money through bonds. The second way, price fluctuations. For example, if a company that issued bonds is not doing very well, price of the bonds will fall, and you can buy those at a lower price. And in this case, you also have two options. Option number one is to wait until the maturity date of the bonds. That is when money will be returned back, and thus you will earn money. Or you can wait until the price of the bonds goes up again, and you will be able to sell them at a higher price, so you will also earn money. Bonds can be of different types, for example, government bonds or corporate bonds, and those vary in their degree of risk, but all in all they are said to be pretty stable. And the third tool is shares. And many people consider shares to be a low-risk instrument, but in fact, it's not quite like that. Because when you buy bonds, you lend money to a company, and you will most likely get those money back. But when you buy shares, you buy a part of a business, and that business can do well, and also that business may not do so well, and in this case, you will lose your money. You can see why it's more risky. With shares, there are two ways of getting income. The first way is an exchange rate difference. You buy for less and sell for more. And the other way is getting dividends. When you buy shares, you buy as part of a company. Some people have a big part of the company. Those are major shareholders. And you and I are minor players. And shareholders can decide to reward themselves for good work. They withdraw money and pay dividends. But not all companies pay dividends. Some fast-growing companies may decide to invest their profit into future development. For example, Netflix doesn't pay dividends. You might ask, why do people buy those shares? If a company invests its profit into future development, it is expected that the shares of the company will grow in price. People expect that to happen. The next financial instrument is precious metals. Those can be bought in two forms: in bullion coins and as financial instruments, such as futures for gold and other precious metals. The next financial instrument can be represented by collective investment and mutual funds. This is an equity participation in an already formed portfolio. So you buy a piece of a pie, and then profit is divided between those who bought their pieces of the pie. Funds can invest into a big variety of instruments. For example, there are bond funds, precious metal funds, real estate funds, and so on and so forth. And there are also mixed funds that invest into different asset classes. Financial instruments or assets are traded on the exchange. This is a platform that brings buyers and sellers together. And in modern days, no one is standing and waving their arms and shouting. Now everything is happening online. And in order to gain access to the exchange, thus buy and sell your assets, you need an intermediary, and this is a broker. The next question is, where are my assets stored and what happens if the broker goes bankrupt? Assets are recorded in the depository. That is a company which is responsible for keeping your assets and accounting for them. If something happens to your broker, you don't need to worry. Everything is written down. If something happens to your broker, everything just goes to another one. And to sell and purchase your securities, you will need a brokerage account. You can open it online. It's pretty easy. Next thing, a person who wants to work with financial instruments must have a strategy. And those can be classified in two types. The first classification is based on how much risk you're willing to take. As far as risk-taking is concerned, investing strategies can be divided into three groups: conservative, moderate, and aggressive. A conservative strategy is when you buy a little bit of everything, you diversify your portfolio, you don't take any risks, and you just wait until you get your steady passive income. And an aggressive strategy is when you try to make as much money as you can right now and you are willing to risk. And moderate strategy is, something in between. Unfortunately, there is no such thing as low risk and high income, because if somebody wants to get you involved into something risky, they need to motivate you, and money is the best motivator. But if the risk is low, why overpay? That doesn't make any sense. So there you have it. Strategies can be also divided into short-term, medium-term, and long-term. Long-term strategies is when you slowly diversify your portfolio, you buy different kinds of financial instruments, you wait until your passive income grows. And that takes a lot of time, 5 years or longer. And short-term strategies is when you try to make as much money as you can right now. You try to buy a lot of shares at lower price and sell them at a higher price. And that is pretty risky, and that doesn't take too much time, about a year. Those are not for everyone. And you also have medium-term strategies. Those are a mix of two, and those last, up to 3 years. And we are all about long-term investment because it's safe. You don't need to wait for the perfect moment to start investing. You just need to buy a little bit of everything. You can carefully and slowly study the playing field, and by diversifying your portfolio, you will get passive income. And we advise you to do exactly that. Raise your portfolio, bring it up as a child, and when you're old, it's going to help you big time. Before I let you roam free into the magical world of investments, I must warn you about scammers. Those are horrible, rotten leeches that wants to bite you and suck on your blood and suck you dry until you are all out of money, and you need to avoid them at all costs. The first type of scammers promise you that if you invest into some magical financial instrument, you will get up to 300% profit per annum. But it's not likely to happen. What is likely to happen is that you will say goodbye to your money forever and never see it anymore in your life. Blow kiss them goodbye and hope that those scammers have good time with it. Yeah, don't do that, alright? And the second type of scammers is a bit sneakier, a bit more cunning and sophisticated. They tell you that they have some magic insight, ability to see the future, given them by higher power. And they might tell you that you need to invest all your money into something, and there is no way for you to lose in this case. They know that this asset or whatever will grow in price and you will get rich. I'm gonna have to disappoint you here, because there's always a risk of something going wrong, especially when the market is volatile, alright? Those people are trying to persuade you to invest large sums of money into something so that they can get profit from market changes. But they don't care about you, they only care about themselves. We care about you, I care about you deeply, on the deepest level of my heart. So, to start investing, you need to follow a simple procedure. Step 1. Sit down with a piece of paper and write down your priorities and financial goals. Step number 2. Understand what stops you from achieving those goals. Maybe you need to get some starting capital, some financial backup in case something goes wrong. Try and figure that out. Yeah, there is a video link somewhere here or down to the description. Yeah, follow it. Step number 3, open a brokerage account. It does not oblige you to do anything, no strings attached, and it will not cost you anything. So what are you waiting for? Step number 4, try and figure out financial instruments in micro steps. Don't throw all your money into your brokerage account. Start with micro steps. Buy one bond, buy one share, buy a small part in an ETF, figure out which button to press, where to click your mouse and whatnot. This way, slowly but surely, you will start figuring things out. And step number 5, you need to learn. Before you throw large sums of money into your brokerage account, you need to fill yourself up with information and knowledge. Our channel is here to help you do that. Last thing for today, 3 main secrets for investment. Secret number 1, regularity and discipline. Try and allocate a small amount of money that you're willing to invest every month, and do it every month. Alright? Be persistent with it. Secret number 2, diversification. Don't throw all of your money into the same tools. Secret number 3, reinvest your income. If you're a long-term investor, you need to use the compound interest rule. Well, that's it for today. Like, subscribe, comment, and ring the bell. Earn money, multiply money, and be happy. And remember, the world is not all about money, but about its quantity. I will see you next time.